Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Bonds are essentially loans made by an investor to a borrower, whether that's a company or a government. They're a key part of many investment portfolios, offering a fixed income stream. When you invest in bonds, you're looking at two main types: corporate bonds and government bonds. While both are fixed income investments, they have distinct characteristics. Understanding these differences is essential for making informed investment decisions and balancing risk with potential returns. Understanding government bonds. Now that we've touched on corporate bonds, let's turn our attention to their government-issued counterparts. Government bonds are a fundamental part of the investment world, often seen as a cornerstone for conservative portfolios. They operate on a different risk-reward spectrum compared to corporate bonds, largely due to the issuer. What are government bonds? Government bonds are essentially debt instruments issued by national governments to fund public spending. Think of it this way: when you buy a government bond, you're lending money to the government. In return, the government promises to pay you back your principal amount on a specific date, the maturity date, and usually pays regular interest payments along the way. Your investment helps finance everything from infrastructure projects to public services. In the United States, you'll commonly hear about a few different types, distinguished mainly by their maturity periods. Treasury bills, T-bills. These are short-term securities, maturing in 4 weeks to 1 year. They are sold at a discount, and you receive the face value at maturity. Treasury notes, T-notes. These have maturities ranging from 2 to 10 years. They pay interest every 6 months until maturity. Treasury bonds, T-bonds. These are long-term securities with maturities of 20 or 30 years. Like T-notes, they also pay interest every 6 months. Pros of investing in government bonds. One of the biggest appeals of government bonds is their perceived safety and low risk. For many investors, they represent a secure place to park capital. Here are some key advantages. Safety and low risk. Bonds from stable governments, like the U.S. Treasury, are often considered some of the safest investments available. The likelihood of a default is very low, especially for strong economies. This is why they are sometimes called risk-free assets, though no investment is entirely without risk. Capital preservation. If your main goal is to protect your initial investment, government bonds are an excellent choice. They are known for preserving capital, meaning you're highly likely to get your money back. Liquidity. Many government bonds, especially those from major economies, are highly liquid. This means you can often sell them quickly in the secondary market if you need your money before the maturity date. Cons of investing in government bonds. While government bonds offer stability, they do come with certain trade-offs that investors should consider. Here are some of the disadvantages. Lower yields. Due to their low risk, government bonds typically offer lower interest rates compared to corporate bonds or other riskier investments. You're sacrificing potential higher returns for greater safety. Inflation risk. Inflation erodes the purchasing power of money. If inflation rises higher than the bond's interest rate, the real return on your investment could be negative. Your money buys less in the future. Interest rate risk. When market interest rates rise, the value of existing bonds with lower fixed interest rates tends to fall. If you need to sell your bond before maturity during a period of rising rates, you might get less than you paid for it. Conversely, if interest rates fall, the value of your existing bond might go up, but newly issued bonds will offer lower interest payments. Understanding corporate bonds. Now that you have a grasp of government bonds, let's shift our focus to corporate bonds. These are a different type of bond investment, offering unique opportunities and risks. When a company needs to raise money, issuing bonds is one way they do it. What are corporate bonds? Corporate bonds are essentially IOUs issued by companies when they need to borrow money. Think of it this way: you, as an investor, are lending money directly to a corporation. In return, the company promises to pay you regular interest payments over a set period and then return your original investment, the principal, on a specific date. This financial arrangement helps companies fund their operations, expand, or even refinance existing debt. Pros of investing in corporate bonds. Why might you consider adding corporate bonds to your portfolio? They often come with some attractive benefits, especially if you're comfortable with a bit more risk. Here are some key advantages. Higher yield potential. One of the most compelling reasons to choose corporate bonds is the potential for higher interest rates compared to government bonds. Companies usually need to offer a better return to attract investors, especially if they have a lower credit rating. This higher yield can boost your overall portfolio income. Diverse investment options. The corporate bond market is vast. You can find bonds issued by companies across almost every industry, from tech giants to local utilities. This variety allows you to diversify your investments across different sectors and risk profiles. You can choose bonds from companies with strong credit ratings, less risk, or look for higher-yielding bonds from companies with lower ratings, more risk, but more reward. That's the first step to understanding bonds. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.